But what caused the financial success was not extreme ability. And I've had results in life that are prodigious. And that came from tricks.
Charlie Munger is well-known in the investment community as a mentor. His strategies have produced the best results for those who follow him. He's regarded as one of the best businessmen and investors in the world. So in this video, we'll go over Charlie Munger's top 3 investing methods that made him a billionaire and can help you do the same. So make sure to stay tuned until the end. Charlie Munger is a well-known figure. We're betting if you work in or even just have a passing interest in investing, you've come across his name. Munger's name has become synonymous with investment savvy, which is no small feat. The more time we spend learning the investment game by taking in everything Charlie has to offer, we realize there isn't anything he hasn't figured out. Charlie has taken all the truly significant ideas from every other field and applied them to investing after a lifetime of reading and thinking. It's his arsenal, so to speak. While Charlie refuses to accept his genius, he claims it enabled him to achieve extraordinary results despite his lack of talent. Over the years, I've gained from attentively examining Mr. Munger's own words and deeds. As a result, I've developed a strong respect for his insightful ideas. Lilu. We have a strange perspective on things. We want to buy something that's essentially a good business, meaning it could be operated by an idiot and yet succeed. Then we want that business, which an idiot might successfully operate, to be run by a brilliant person. If we have a fantastic business operated by a fantastic person, it really turns us on, and it works extremely well. We do make exceptions, but there are few. It's a straightforward philosophy. Warren often states that you must choose between being a nice person and being a good business person. What exactly does he say? This isn't a politically correct statement. Good business, he says. When I was practicing law, a friend told me if it can't handle a little mismanagement, it's not much of a business. We like companies that can withstand a lot of incompetence but nonetheless succeed. That's how we work. We weren't able to make it ideal, but it worked better than most people, says Munger. Let's now see the top 3 investing tricks from Charlie Munger that made him a billionaire. Number 3, patience. It appears to be really straightforward. When there's nothing worth doing, just do nothing. Most investors, however, find this elusive. They convince themselves or others that if they were smart enough and worked hard enough, there would always be something intelligent to do. As a result, they fall into the trap of good enough. Each compromise appears tiny or not at all, but they're finally well below the commanding heights of investment discipline to which they had aspired. Temperament is also vital in this situation. What exactly does that imply? Consider a situation in which everything goes wrong for you as an investment. Your investments are being marked down by the stock market. Your peers are against you. Your customers are beginning to question you. You haven't had a successful market year in a long time. Will you be able to keep to your well-thought-out investment strategy? Will you crumble and give in to the anguish, deviating in an attempt to catch up sooner rather than later? Charlie is emphasizing the fact that not everything about investing can be learned. Yes, you can read any of the excellent investment books available, and you should. You can research all the previous successful investors. That is nevertheless necessary but insufficient. You also require specific attributes that some people possess while others do not. Number 2, wait for the great opportunities. Munger looks for business prospects that aren't simply fantastic, but so obvious that they're no-brainers. They don't do anything the rest of the time. This makes things a lot easier by reducing the amount of information required. Charlie Munger's primary investment advice is that you don't need to know everything about every corporation and have 100 insightful information in your life. Instead, you just need 2 or 3 key insights and large stake in them. Berkshire Hathaway, according to Munger, was based on the top 10 decisions they've ever made. Being patient has positive implications as well. You pay less in broker fees, pay less in taxes, supposedly because capital gains are realized less frequently. And you can filter out a lot more noise about unnecessary minutiae when you make fewer transactions. Warren Buffett is another strong believer in diversifying your portfolio with broad market index funds. The Oracle has repeatedly recommended retail investors to purchase a cross-section of America in the guise of a fund that tracks the S&P 500, for example. When it comes to the average investor, Munger may agree with him. Munger, on the other hand, does not believe in spreading one's bets when it comes to professionals who want to invest on your behalf. A lot of individuals believe that having 100 stock means they're investing more professionally than having 4 or 5. This is insane in my opinion, complete insanity, he asserts. He said, I call it diversification, which I stole from someone. I'm far more at ease holding 2 or 3 stocks that I believe I understand and where I believe I have an advantage. Should you sell your index funds and invest in a few high-quality stocks instead? Unless you've amassed a multi-billion-dollar fortune in the stock market, probably not. However, Munger's ideas are applicable to the little fraction of your portfolio that you can utilize to supplement your diverse core holdings. Those truly high-conviction decisions can account for 5 to 10% of your portfolio. Just don't risk more than you're willing to lose on 1 or 2 picks. Number 1. Beware of bubbles. Several investors question Munger about the market's perceived froth, comparing the ascending trading of new businesses going public to the late 1990s dot-com boom. I believe this kind of irrational speculation in businesses that have yet to be discovered or identified is an indication of an irritating bubble, Munger stated. I think it must end poorly, but I don't know when, he said when asked if things will go badly. When the dot-com bubble burst in March 2000, the S&P 500 lost more than 49% of its value, and after the housing market crash in 2007, it lost over 57%. However, don't get too worked up and sell all of your investments. Instead, Ben's advises stay diversified. She recommends having a core portfolio of wide market mutual funds or exchange-traded funds which are made up of a variety of stocks that'll react differently based on market conditions. One of the important things that everyone should understand, she explains, you want some of the sexiest enterprises as well as some of the most boring. She admits that the beautiful ones are currently quite attractive, with eye-popping returns that appear to make holders wealthy in just a few days. If you're set on experimenting with individual equities, which are more volatile than a large basket of companies, she suggests starting with a tiny portion of your portfolio. As a general rule of thumb, individual equities should account for no more than 5 to 10% of your portfolio, she advises. The remainder of your portfolio should be in a more widely diversified asset. A shareholder also questioned Munger how investors might deal with periodic investor frenzy such as the recent sky-high run-ups in the so-called meme stocks. Capitalism has 3 phases, Munger explained. I've been around a long time, and my policy has always been to ride things out. That, I believe, is what shareholders do. What is it that Munger wants investors to avoid? What a lot of shareholders actually do is buy stocks in a frenzy, often on loan because they perceive them going up, he explained. Of course, that's a pretty risky investment strategy. Munger went on to compare this type of investing to gambling. According to Sam Husksow, a certified financial planner and founder of SGH Wealth Management in Southfield, Michigan, he's not wrong in doing so. There should be a reason for every investment. You're a rudderless ship if you can't come up with a rationale for why you're investing that money, he says. Then you're treating it like a game of chance. You're just hoping for good fortune. According to Kristen Benz, director of personal finance at Morningstar, those investors have recently struck it rich. Investing in stocks that have gone up a lot in the last year has been a good idea, she says. However, we know from history that past performance isn't always indicative of future performance. She recommends sticking to the plan to avoid the chaos. The first step should be to invest in your personal ambitions, she advises. Think about what you're saving for and make proper investments. A few terrific stocks held for many years are all that's required for a lifetime of investment success. Live within your means to ensure that you have the finances to invest when these possibilities emerge. And don't be hesitant to invest large quantities when the odds of success are high. Munger's tricks, if executed correctly, can enable you to accumulate massive quantities of money over time and eventually can also make you a billionaire. So that brings an end for today's video. Thanks for watching. If you enjoyed it, please like, share, and subscribe to our channel for more such great content.